And welcome to the ETF Edge portion of Halftime Report. I'm Bob Pisani. ESG, still a hot topic, but how do we agree on what exactly it is? ESG, that is environmental, social, and governance ETFs, continue to attract big money, but the inability to clearly define what's being measured has drawn a lot of criticism, including from the head of the SEC, Gary Gensler. Joining me now to discuss is Larry Swedroe, Chief Research Officer at Buckingham Strategic Wealth, and he is co-author of the new book, Your Essential Guide to Sustainable Investing. Larry, in your book, you point out that ESG is maturing, but the main stumbling block remains the inconsistent standards for judging ESG. There are 7 ESG rating agencies out there right now. Can we come up with a set of standards that everyone can agree on?
Well, as you point out, we have a problem. It's not like corporate bonds, Bob, where we have 3 raters and the correlations are virtually 100%. So Moody's, Fitch, S&P, if one rates a company BBB, the others almost certainly do. With these 7, they're totally different. And that creates big issues because of how they weight the E, the S, and the G and different factors within them. And so we're stuck with this problem, and I think the 2 likely candidates to resolve it, if it's possible, are the SEC or an accounting standards boards. But my view would be certainly that the 7 providers have no interest in doing so, because you don't need 7 if you have a consistent rating system.
Yeah, we're going to need some international standards and maybe the SEC as well. Now, the other big issue everybody keeps asking me is, does ESG actually outperform? How do highly rated ESG stocks or funds stack up against the overall market? What's the conclusion?
Yeah, well, as always, I think you should start with economic theory. And here, if you have a large enough group of investors, which we certainly have with something like 30 trillion now invested in ESG strategies, if they're screening for good companies, those stock prices, valuations, PEs will go higher, and the screened out stocks will go lower. And that means, since you're not affecting their earnings, just the valuations, the good scoring companies will have lower expected returns than the bad scoring companies, higher expected returns. And that's exactly what the evidence found, that the Brown or the Sin stocks for a century or so had outperformed by about 2 to 3% a year. However, we have a conflicting force in the last 5 years with huge cash flows coming in. They're driving up the valuations of the green companies, creating a greenium in the short term where they're outperforming. We may be in the early innings here, so that could continue for a while longer. But once we reach an equilibrium, green stocks should be expected to underperform in terms of return. Brown stocks outperform. Finally, green stocks should have less risk because you have less risk of environmental spills, frauds, boycotts, those things.
Okay. And I love that word, greenium. That's a pun on premium. We're going to have a lot more on this. Thank you, Larry. Much more on ESG coming up on ETF Edge, 1 p.m. Eastern Time. Larry's going to break down what he believes is working and is not working with ESG investing. He'll be joined by Mona Naqvi, the global head of ESG capital markets strategy at S&P Global. That's ETFEdge.cnbc.com.